Good afternoon. The first thing I see is the timer, which is always a good thing. So let's start off. So what we'll do is we'll talk about who we are first. So we are a global company which specializes in information analytics and solutions for the customer lifecycle management. We are a 30-year-old company present in about 55 countries, customers, 30 country-based operations. India is one of them. So what do we do in terms of customer lifecycle? From a pre-qualification standpoint, we support through the usage of analytics and automation. What we do essentially in terms of pre-qualification is to discriminate customers in terms of riskiness and in terms of likelihood to accept an offer if you make an offer. And this essentially is a function of data, analytics on top of it, and implementation of this in a solution that is configurable and flexible. So from the pre-qualified pool, the next thing we look at is customer acquisition or underwriting, as it is called. So from an underwriting standpoint, we look at two things. One is intent, the other is capacity. These represent itself in a number of analytic solutions in terms of risk, in terms of fraud, in terms of app scores, in terms of profitability, income, as well as personality assessment. Fundamentally, if you have the data, you can build analytics. If you build analytics, you should be able to deploy it in such a manner that you can respond to the market. And that is where the IT solution comes in, where you can configure every analytics piece that you've built. You can put policy overlays on top of it. You can do your cutoff simulations. You can configure your underwriting strategy. Post-acquisition, what are key problems that you should solve for? One is predicting behavior or looking at behavior to predict loyalty. Second problem you should solve for is if you go back with an offer, what's going to be the response? The third is if out of 100 respondees, you accept 60, what are the portfolio losses you are going to take? Use cases in lending is portfolio losses. Use case in insurance is claims ratio. Use cases are the same. So again, use the data, do analytics, deliver it in a solution where you can put analytics plus policy plus go-to-market strategies, make sure that that solution is configurable and is vendor independent. And finally, in terms of collections, what do you solve for? You solve for channels, you solve for cash accounting, you solve for allocation strategies, and you solve for feet on street. So once you solve for all of this, you get the same thing. Use data, build analytics, put it in a solution that is configurable, and help the customer become independent of CRIF change requests. So just expanding. In terms of acquisition, you qualify the right customer, you make the right offer at the right time, and the channel through which the offer approval is likely to be highest. You reduce the probability of bads. You of course increase efficiency. and you standardize policies. You do all of this through policy rule optimization, because analytics scorecards are information assets that are non-changeable for the medium term, because you build it on a certain data set to look at for a certain period in the future, and unless the model has enough bads, you don't deliver competitive advantage. How you deliver competitive advantage more often than not is the flexibility through which you optimize policies. Because enough bads on a scorecard takes time. Enough bads on a scorecard that is devoid of any external interventions, like when you have a demonetization and a GST in a 12-month period, it means that all your scorecard performances are delayed by 24 months. Because that bad is not necessarily an externality independent bad. It's an event bad. So you generate advantage through policy rules and then a series of scorecards, whichever makes sense for your organization in the stage of evolution. It could be riskiness at a product level, which is what is called the bureau lookalike scorecard. It could be an app score if you have enough vintage. It could be a fraud prevention scorecard, a customer profitability scorecard, an income segmentation scorecard, or for that matter of fact, a psychometric score which can deliver competitive advantage in business loans more than any other place. In terms of customer management, as I said, the first thing you want to predict is customer lifetime value. Does your organization look at a customer as a single transaction, or does your organization look at a customer as a series of transactions through which you will finance the lifetime needs? There are NBFCs who have changed their vision statement from the former to the latter. You increase customer loyalty. By increasing loyalty, you also address profitability. And of course, the other aspect of customer management is to generate early warning signals so that you avoid additional exposure to those people who are likely to show stress. So of course, you have a risk-based cross-sell or an upsell. You look at the possibility of a balanced transfer, both BT out and BT in. You look at churn. For NBFC MFIs, churn is a big problem. Customer retention. You look at lifetime probability, and then with all of this, of course, you look at either the IND AS or the IFRS 9 framework, because lifetime computations have to be linked to lifetime loss and the provisioning that you need to make today for the loss of tomorrow. So 100% goods in a model don't deliver any competitive advantage. The competitive advantage of a model comes when you have enough bads. In terms of collections, what the decision engine should do is actually segment or separate bad from good. For every customer, it should actually predict, at least in the early collection phase, whether tomorrow you need to make a provision for it. And what, at a contract level or at a customer level, is going to be your loss given default and your exposure at default. That is capital set aside. You need to also look at channel allocation, basis segmentation. Which customer is more likely to repay if you put them through a dialer versus which customer is more likely to repay if you put them through agency A? Or is your agency A performing better in a certain delinquency bucket so that agency B cases should also be moved to agency A? You of course impute the probability of recovery, which is nothing but looking at rollback rates on your portfolio and benchmarking that with whoever is your relevant competition. Now you have these decisions. What are the workflow actions that you can take basis these decisions? User or agency management, rule-based allocation, integration with dialer, determining whether you collect through cash or through non-cash. If you collect through cash, letting the cashier in the branch know how much cash has been picked up and how much cash to expect. And of course, dashboards and reporting. How does analytics help? It gives you a collection score. The collection score, one of the aspects of the collection score is also to say that is the likelihood of collection going to reduce if you take a collection action? So is this person self-cure? We spoke about allocation optimization, which agency to put it on the dialer versus put it in the agency. And of course, you look at the rollback rates. So, simplistically put, analytics by itself, you should look at it as an optional module that delivers advantage. You should look at IT or software as an optional module where if you have an interface which allows you to be flexible, delivers a competitive advantage, it is absolutely not necessary that you need to do both at one go. Whatever is the choice is completely up to the evolution stage in which your organization is. So how do we work with our customers? We first identify the challenge. Now the challenge can be in terms of effectiveness or efficiency. The challenge could also be a cultural challenge. Once that is identified, then we will look at the solution recommendation, and the solution recommendation is not necessarily always a big bang approach. It is to say what are components that are optimal for you at this stage and what you should measure over the short term and the medium term to look at your next phase of rollout. Therefore, analytics basis your strength of the organization can today be prescriptive and not predictive. Is it absolutely necessary you need to have a scorecard to do better analytics? The answer to that is no. You may actually have a series of policy rules which, if you optimize, gives you better analytics, at which point it is prescriptive and not predictive. And basis that, you could move into predictive. Predictive is scorecards. So as I said, implementation is configurable. Integrations are channel agnostic. And the key reason why people work with us is because we bring bureau data, we bring analytics on top of that data, and we bring software solutions in which you can host analytics and policy. And we do this more often than not in a multi-year engagement model which measures performance. So it is not just a build and transfer. So that's all I have. If you have any questions, the team is here, or you can write to reach.india@crif.com or info@crifimark.com. Thank you.